Our weekly inflation segment continues, and on a day when oil closed at 3-month lows, we're taking a look at what's driving shipping cost. It's never been more expensive to ship goods all around the world, and as ports try to work out from backlogs and transports try to keep up with consumer demand, who in the sector is best prepared to pass on those costs to their customers? Joining me now is David Vernon, freight and shipping analyst at Bernstein. David, thanks for being here.
Thanks for having me.
So we talk all the time about supply chain. Supply chain is a very, very broad term. Let's drill down a bit. What areas right now, in your opinion, in the supply chain, trucking, rails, intermodal, whatever it may be, what's causing all these price increases? For example, back to school shopping, 40% higher this year. And which one of those areas has continued pricing power as we go forward to the second half of the year?
Yeah, I mean, if you're looking for the underlying driver of all this, I think it's just the global economy getting caught wrong-footed on how strong consumer demand was going to be coming out of the COVID recovery, or coming out of the initial kind of waves of COVID. That led a lot of manufacturers to pull back on production capacity. It took away a bunch of manufacturing capacity as well as transport capacity. And then as consumers kind of kept buying, we just ended up in a situation where there wasn't enough capacity to move goods around the world. So you think about international markets, the closure of the passenger airline networks, combined with just a huge amount of demand for goods has driven air freight rates to really, really high levels. Ocean freight rates, again, it's about trying to fit containers through an undersupplied market. And that's just forcing spot rates to get bid up and up and up and up and up. I don't think your bigger retailers are maybe paying that spot rate, but you definitely have a lot of upward pressure across the chain. As far as who's going to be able to kind of pass this through to their customers, transport industries are in a good position here because if you can't afford to pay the freight, there's other people that are trying to get on board. So I do think that broadly speaking, transport carriers are going to be able to push through these higher costs. The best positioned companies from our point of view would probably be the railroads. Just because they've got a more limited amount of cost pressure to go ahead with to pair with the higher freight rates they're going to be able to charge over the next 2 years.
All right, very interesting. Railroads with better pricing power. Generally, people go to the rails because they're cheaper than trucking. But speaking of trucking, that's about 80% of supply chain spend globally for companies just trying to get things where they have to go by truck. I spoke to the CEO of Knight-Swift, the nation's largest trucker. He says he doesn't see those rates that are about 50% higher year over year going down anytime soon. He says maybe not even until spring of 2022. Why don't trucking companies have more pricing power, and why haven't investors just piled into those as we see the supply chain back up?
Well, I think the truckers will be able to push rates through, right? I mean, they ultimately have the power of just hanging up the phone if a customer doesn't want to pay the freight. They don't have the capacity in the right position. They're in a very good spot. I think investors have a hard time capitalizing that type of pricing power into more cyclical businesses like that, because at the end of the day, if rates go up, more capacity comes in, you're going to see the other side of that pricing environment pretty quickly in some of the truckers. Now, I would say that bigger, better, well-capitalized companies like Knight are definitely in a good position with respect to where rates are going, because they're not going to be dealing with some of the same challenges that smaller truckers will be having in terms of driver turnover and being able to quickly balance out a bigger network. So I think bigger companies are going to be in a much better position here than some of the smaller.
All right, David, we're almost out of time. Just really quick, we're looking at Dow Transport's trading down today. A lot of other transports trading down today. Why are they ever trading down? We know there's so much demand piled up and just waiting to go on these different networks. Just very quickly, why would you not bet on transports right now? So we are more bullish than bearish on the sector, but I think that we're in a weird period of time here in the summer months. I think you have a situation where traditional cyclical investors are looking at conditions that maybe are too good to be true, too good to sustain into next year. So there's some reluctance about going to want to kind of buy in at a peak rate level. So I think you do have the market trying to figure out and discount when we're going to get on the other side of this rate environment, and not wanting to be sitting in a position where you've bought in at what could be peak pricing. All so right. Your more cyclical industries, particularly, are going to see it's going to be hard for them to hold this good rate environment into their share price.
Shepard Smith here. Thanks for watching CNBC on YouTube.